How's it going out there? It's July 21st. My friend Curzio, it's the Wall Street Unplugged podcast where I break down headlines and tell you what's really moving these markets. So I have a great interview set up for you right now. I say that every Thursday. Every interview is great. This one's with your buddy, your friend, most popular, Andrew Horowitz, president and founder of Horowitz Company, incredibly smart analyst, great trader, and host to the longest running financial podcast only by a few months over someone that's a really good looking and great guy. I forgot his name, but his podcast is called A Disciplined Investor. Andrew, how's it going, buddy?
Hey, Frank, how are you?
I am doing good. I mean, I'm fired up, man. I'm starting to get a little bearish because I saw some statistics recently showing that it's sentiment-wise, when you look at fund managers, this is from Bank of America, which I just saw, which was 2 days ago, saying that all sentiments at all-time lows. You're seeing cash balances at 12-year highs. We're seeing a market that's down tremendously, and we know the risk, we know inflation, but when I see all-time ever, right, it gets me excited from a contrarian point of view. But what do you think what's going on? We're seeing inflation.
Wait. Let's just back up. Let's just back up. You said when you started the discussion that you're getting a little bearish. That's what you said. Did you mean bullish?
Bullish. I'm starting to get bullish because everybody's so bearish.
Well, no, you're going through this whole scenario because this is a really good point, though, that you make that when there's everybody on one side of the boat, what happens? And literally, let's think about a boat for a second, right? Where you have a boat in a situation where everybody says, oh, my gosh, look at that over on the left side of the boat, or as we call it in the boating world, the port side. Everybody runs over to the port side, and what happens? The boat starts leaning, right? Everybody starts leaning over. It starts leaning over. And everybody's like, oh, my God, we're going to sink. So what does everybody do? Faster than before, they go to, as we call it, the starboard side. And then the boat flips over. So where we are right now is in a very bearish situation. You talk about the Bank of America poll that came out that talks about the positioning of retail and institutional. It's the lightest. I think it was the lightest since the Lehman debacle, right? And the most bearish that they've seen, I think, on record. That's really interesting. And what's interesting to note about that is once everybody gets a hint and knowledge about everything that's going on, the last person standing finally figures out, oh, things aren't so good moving forward. It's often a time that it's a turning point. And whether it's that day, that month, that week is a different discussion. But there are some, as you're probably saying, due to your contrarian view on certain things, there's some bargains out there.
There are some bargains out there. And here's the report that I highlighted, and I know you could see this when we have it on our YouTube channel, but this is the Bank of America report came out 2 days ago. Recession is now consensus. Everybody believes it. But look at the other two times, March 09, April 20, which we kind of in a recession those times. Global growth optimism, all-time low, worse than World War II, worse than, you go back.
Unbelievable.
Global profit optimism, all-time low. Then they had another chart here, which I thought was interesting, which is cash levels high since 2001. So, when I'm looking at things like that, look, and I don't want to discount the risks, right? Because we see the risks. But one thing that I do want to say is markets are terrible during uncertain times. The Fed is becoming more certain. I know we all have a negative view of the Fed and what they did and they relate to the party, but we know what they're going to do going forward. I don't think they're going to be as aggressive. Obviously, you're seeing them calm down after the CPI, PPI with the 1% and 75 basis point hike over the next two meetings. And that only took a week to really, to dial down a little bit. But we're seeing a lot of stuff they're doing working in terms of commodity prices are coming down. We're finally seeing signs when we saw no signs, right? We're seeing, you look at inventory levels up 35% for Walmart and Target. M2 money supply, you're seeing money come out of the market. And now for them to want to double where we are now, 1.75 and double it over the next 2 months, I think is insane. But if we get anything dovish in September, which is a possibility, because now we're really seeing these numbers hit, like you said, there are a lot of bargains out there. There's still risk out there, but man, it's if you're an investor not investing when things are down 30, 40%, then when are you going to invest?
Right. So, Frank, for those listeners out there that maybe haven't necessarily studied eco, back in the day when eco was actually a thing, right? Remember the days that we actually watched all the economy and all was going on because it mattered versus just the economy that was like, okay, well, what's the Fed going to do? That's a whole different discussion. But back when we were first learning about this, one of the things we did know was about monetary policy, generally speaking, about the ebbs and flow, the velocity of money, the power of don't fight the Fed, the idea that when an economy needs to be slowed down due to a variety of factors or sped up during a recession, there was a variety of things that can happen from a fiscal and a monetary side, right? Okay. But one of the things I think that we learned back then, and I think when I say back then, I'm not talking about like 1940. Okay. I'm talking about in modern times, but when there was really an economic cycle that was being taught rather than just, hey, let's just put all our money to work because stonks for the long run are going to be great. A la Jeremy Siegel and our good pizza friend. Why can't I remember his name? One
Kramer,
bite.
bullish. Are you talking about bullish guys?
Not Kramer. Yeah. What's his name? That was We was the gambler, Penn National. David.
I mean, Tom Lee's.
I know everybody on the.
Right?
Well, he's crazy bull. Anyway, Dave Portnoy. That's what I was thinking about.
Oh, okay.
I don't know where that. I obviously, my mind purposefully shut him down. Okay, so here's the thing. And tell me what you think about this. It takes time for policy to make its way into the economy. Would you agree with that?
100%. 100%. And
when I say time, Frank, we're not talking about a week. We're not talking about a month. We're talking like a move. It's like moving the Titanic, moving economic policy from, let's say, accommodative to restrictive, to taking money out of the markets. I have friends that are in the plumbing business. They're busier than ever. Mm-hmm. Why is that? Well, they're in the commercial business. So buildings that were being built are still being built, right? Exactly. So all this stuff that happened last year is now coming into the economy now. Now, that may mean that there is a slowdown coming in a year from now. Point, though, is why the hell does the Fed all of a sudden believe that they can rely on every economic print? And why is the market giving them the authority to believe this, that they can then move their interest rates dependent on one or two CPI prints? Does that make any sense?
No, and it's very dangerous. It's a very dangerous precedent because
I don't get it.
No, I mean, we're from 0 to 1.75 is where we've gone since January, and we're seeing the effects, especially over the past 3-4 months when we got really aggressive. Now, doubling of that, I mean, you want to see frozen. We can go down tremendously, and I expect them to overshoot, and they are going to overshoot. If they go 50 and 50, yes. I think they're going to overshoot.
Yeah,
but you're seeing this as evidence, but the real-time data of when you're looking at copper, holy cow, I mean, 450 to 325.
17th month low on copper. Yep, right, 17-month low.
Oil price were 130, right? And they're 100. Still high. I'm not saying that they're not high, but we got to talk about Fed policy and sentiment here, because as this slows, and you're looking at expectations for inflation are down very, very low, meaning that most people,
right?
And even in this, in the Bank of America study with these CEOs, they believe that those expectations and inflation is coming down, which means interest rates are coming down, right? So if you're looking a year from now, look at GDP. GDP is the ultimate factor where we were looking at 3.7%. This is like 6 months ago. And now where are we? Like at 1.8?
2.3?
I see 1.8 print now, 1.9 print.
No, there's 1.8 some of the pessimistic side, but I think IMF just came out last week with 2.4 dropped down from 2.6, 2.7. Yeah, but they're always slow anyway and much more bullish.
Yeah, and then I've seen below 1% on 2023. And just taking, this is from, I think it was an article, just put everything together. But again, you're seeing them drastically come down. That's the expectation. So you have to be careful about overshooting, but you're seeing clear signs of it. And you have to remember when you're looking at this and you're reading the headlines, right? Which you and I do. We read the headlines and tell, what's BS and what's not, right? That's our jobs on a podcast. That's why people listen to it.
Well, just to restate that, Frank, we read more than the headlines. That's the point you're trying to make, right? We don't just read the headlines. You got to slow down sometimes, Frank. We don't just read the headlines. We read the actual article and data behind the headlines. That's where the power is, right? Not the headlines.
Even the articles are kind of BS too. I mean, they're going to support the crazy headlines sometimes, right? So that's right. Kind of what I meant. But when we're looking at that and we're saying, okay, if you watch TV now, it's ultra bearish. You have to remember stocks are down tremendously. Like if the NASDAQ here went up 15% off its lows, we'd still be down 20% from its all-time high. And that's what you have to realize, because for me, seeing ideas where the next 2 months are going to be crazy, just the last week has been crazy. What bank stocks were out of favor when JP Morgan reported 3 days later, everyone wants banks and Citigroup and Goldman Sachs raising their dividend. We saw CPI and PPI released how also the travel stocks got destroyed. Look at the airlines. All of a sudden they're back in favor. Wait a minute. We are seeing demand. Should Delta be trading at the same level as trading when 95% of their revenue is shut off compared to now when they just have record revenue, and I know margins are tight and I know they're having trouble hiring pilots, but should we be trading at those levels? That's what happens when you're seeing a total deleveraging where a lot of good names are coming out, which wasn't long ago, Andrew, when we came on this podcast and I said, well, what do you like? And you're like, I don't like anything, which you were right. And that was about 3 months ago, maybe. Mm-hmm. Now, at the beginning, you said, well, there's some bargains. I know you have proprietary, formulas and data through your systems that show up. What are you seeing on your screens?
So it's interesting. Energy has come through the screens quite effectively over the last, I would say, 4 or 5 months. Energy never comes through my screens, ever. Mm-hmm. And I'm like, when you see something like that, like if a bank ever came through, I'd be like, what's up with that? Why is that happening? And energy started piling in. We dropped it down a little bit. Technology came down dramatically as well. But there are some areas I think that you have to really think about. Wow, there is some opportunity. Even if some of these stocks come like 30% off the bottom, they're still down 90% or 80% or something like that, right? Some names that if they're going to be there. Now, I'm not talking Cathie Wood style, right? Which is, I think we're going to see a great boom ahead when her portfolio is down 60, 70%. You need to come up like, 180% to get back to even. That's very difficult. But right now, what we're talking about, Frank, in my opinion, is what's happening in the world is that essentially first of all, we're talking ourselves into a recession. I think that's a big issue. I think that everybody is so afraid of this word. And I don't think, with all due respect, that a lot of people really understand what that means. Here's the thing, Frank, I'm going to give you a job. Frank, you're going to work for me. You're working for me, Frank. I'm going to pay you. You're only working part-time, but I'm going to give you $10,000 that year to work for me. Okay. Mm-hmm. And you're happy as a clam. We have a really good year. I give you an extra $5,000. So that year you made $15,000. The following year, I'm going to go, Frank, you know what? We're doing well, but that was a one-off kind of weird. We got something that went on. It was unbelievable. In the next year you make $11,000. So you're making 10% more than you did originally, right? 10% raise.
Mm-hmm. Yep.
But you're really down about 30 something percent from your peak from where you were, right?
Yeah.
Because you made, right?
Of course. Yeah.
That's exactly what's going on with earnings to a degree. So what happened with earnings is this, that we saw that earnings got spiked for two different reasons, two major occurrences that happened. One, tax reduction, big boost to bottom line, right? Would you agree with that?
Absolutely. Huge. Massive.
Massive. Second thing, right on the heels of that, and by nobody's design at all, is they got this huge influx of cash from balance sheet increase of the Fed and through monetary stimulus, through fiscal stimulus. This just tidal wave of money came in and was being spent on everything and anything. And listen, in a world where we can have an ape smoking a cigarette go for 17 million, there's some excess money being spent, right? So a cartoon that is. So all of a sudden, here we are. Like, did anybody not think that earnings probably not going to stand up as well? So what we have is on the back end of this, just like the next year, you're making good money. Your revenues are actually good, but your margins are a little bit squeezed because of a couple of different things. Your earnings are still okay. They're just back down a little bit from where that big giant pop was, maybe to last year's numbers. Does that mean we need to reflect the pricing down 60% on your company? Mm-hmm. I don't know. It seems a little bit insane to me. It seems like we're trying to now do a more of a linear calculation that the earnings are going to be down like this for the foreseeable future, which makes no sense at all. So now we have two different animals that are involved in the markets now. So we have the penguins and we have the ostriches. The ostriches are the everyday person that says, you know what? I just can't look at my portfolio. I just can't do it. I know things are down. I don't want to look. You know what? I don't want to see what's happening. I bought all these stocks and I didn't exactly know what I was doing. I'm not selling them because I don't know exactly what I'm doing, but I just can't look. Making a very, very big mistake, because what they're doing is they're basically sentencing their portfolios to a lifetime of disaster, of doom and gloom, if they have the wrong positions in there, right? So somebody that's like, oh, I bought Cathie was ARC, or I bought some of these other stocks. I just let them just go down forever. One day, hopefully they'll come up. Mm-hmm. Really? Is that true? The second animal we have are penguins. Right now, after all this time, the penguins have appeared right at the edge of the beach, right on the edge of the iceberg. You know what happens? They all start lining up, right? Mm-hmm. And you and I are penguins, Frank. And I look at you and go, what do you think? And you say, I don't know. What do you think? I say, I don't know, looks a little cold, the water. We got Joe in the back going, hey, what are you guys doing up there? And then finally, Frank, you're like, you know what? I'm going. You go? I'm like, Frank went. I'm going too. All these are the analysts right now that are now starting to drop price targets, right? They're all starting to say that we're going to go into a recession. They're all following along with each other. Where were they 6 months ago? Was anybody dropping prices 6 months ago?
No.
Nobody. So we got all this going on right now. We're talking ourselves into recession. We got people not looking. We got the penguins that are just jumping in and saying, yep, we're going to be dropping prices down. And then we have the thing that happens with the banks. The most bizarre situation. They come out with their earnings all over CNBC and all these other sites. Bank earnings down 25, 30, 40%, right? But they don't tell us exactly what those earnings would have been if they extracted out the set-asides for bad loans, right? Mm-hmm. We have giant set-asides that were put on during the pandemic that were released, pushed into earnings last year. Now we're increasing them again because people are concerned. The banks are concerned that maybe, some soft times ahead. But they take those out of earnings. So now all of a sudden, we don't get any comps from the powers that be on TV. This tells these horrible numbers. Mm-hmm. No wonder why stocks reacted so positively to the fact that things aren't as bad as people think. And I think you're going to see hit or miss. We'll see what happens with some other names. But I think you're going to see that there's a lot of resiliency in some names, or better said, it's not as bad right now as they're making it out to be. So that was a long-winded yodel from me. Sorry.
Listen, I hear you 100% because you're seeing the taxes. I think it's 2018-19 when that came in. Holy cow! I mean, remember AT&T was giving free checks to everybody and said thank you very much.
$1,000 for you, $1,000 for you,
raising the dividends or whatever, right? But now again, you injected all this money, you push forward a lot of business, and now you're seeing it come out of the markets. But this earnings season is going to be interesting, and for me, I'm getting bullish. I'm bullish now, but I'm very careful where I know that companies may report like an IBM. And IBM's numbers, I mean, it's one of the top performing stocks of the year, right? It's probably down.
It was up 3% until their earnings, Frank, this year.
Yeah, outside of energy, everything, right? It's probably outperformed everything. Mm-hmm. But it came down after earnings, and it was interesting what they said because you and I talk about this, which is funny because nobody mentions this when the dollar is weak, but the dollar is strong now, and IBM operates in like 170 countries. But going in, you're going to see companies where the dollar is stronger, especially over the last month or two. It's going to hurt earnings for these multinationals. You're going to see it come, and they're going to say the famous words that we like. Or famous word, X currency, if that's one word, X currency.
Or constant currency. We made great money.
Which is great. But also, this is the opportunity when your stock is down, again, and for CEOs to issue cautious guidance. Because it is. The supply chains are starting to open up based on the data I see for the first time in a very, very long time. I know a lot of companies were lying out their teeth for 2 years. It was opening up. It's not. I get great data on this for people who track it for 25 years. You're actually seeing the ports open up because demand's starting to slow a little bit. So it's getting easy to produce things and ship them.
Yep. It's
going to be interesting to see what these CEOs say because you're going to offer cautious guidance. You might see a lot of IBMs and JP Morgans, with Jamie Dimon, kind of like, very, very cautious. But that's going to be an opportunity. I mean, you don't want to buy ahead of that and be down 10% in a day, but there's a lot of names trading at discount based on prices where insiders are buying right now. You still see their growth intact. They're going to go earnings maybe a little bit slower at 8 to 10%. But for me, there's more names popping up on my list where small caps are the cheapest that they've ever been. I haven't seen a cheaper time.
On a relative basis, right? On a relative basis, or are you talking about on absolute?
No, on absolute. So basically, if you're looking at growth, even from a PE perspective, they're one of the lowest all times. But you're looking at growth, which has been discounted significantly. And remember, these guys don't have to worry about a stronger dollar. It's actually better for them. Most of them small caps are doing business in the U.S. compared to the multinationals and S&P. So when I see valuation, not every company, but there's a lot of companies that I'm looking 12 to 18 months from now that, I mean, if you're buying a lot of names, they're probably going to be a lot higher from now because I can't see the Fed staying this road, continue to raise rates. I think September they raise and they're going to say, okay, we're going to wait. And that's going to be a big boost to the markets. In the meantime, this 2 months is going to be like it was the past week.
And by the way, they cannot afford to say anything other than they're going to continue with their program until they change. If they even hint that they're going to slow down in the future, like, okay, we're going to raise now, but September we're going to halt. No good. They have to the very last second, they have to continue on with their conversation, with their, as I say, their leather boot to the throat of the markets, saying, you know what? we are going to raise, because otherwise you get the wrong impression what's going on. But I think you're right. I don't think there's any CEO that's worth their weight in salt that would take this opportunity to be very bullish. There's just no reason to be. There's just none, right?
Yeah.
You can hide behind all such a crap. You could list, well, we got the war, we got the close down of this in Russia, we got the higher cost of items and materials, and we got the supply chain from China and the COVID issue, and we got, the list goes on and on and on. Pick any two, right? One from column A, one from column B, and if that doesn't work, throw something in about the weather. That would be what they should be doing this quarter, as crazy as that sounds, because there's no reason to bring up the speculative optimism with investors only to have something go wrong down the road. They'd rather, be under promise and over deliver, right? Isn't that the whole point?
That's the point. And look, your estimates have come down. I mean, you look at Tesla, where they said supply chain concerns and Shanghai and the lockdowns in Shanghai. I mean, their number was 183. In April, that number for the quarter was supposed to be $2.31. It's down to $1.83. I mean, just to put that in perspective, even at that number at 183, it'd be a 43% decline from last quarter's $3.22. So if you're not beating those expectations, I'd be surprised, but expectations are down and people are expecting misses. This is a time to be conservative, where you're not have these high expectations where you have to be overly optimistic sometimes, and that's what gets these CEOs in trouble. But now is that time, and you may see your stock fall a little bit, give you a little bit more of a discount. I'm not saying that we're at the absolute bottom. I'm just saying 18 months from now, looks like at these levels where I'm seeing so many names trade at these valuations, it's just attractive, especially as everyone's leaning towards one side. When they see all-time this, all-time that, the contrarian may just be like, holy cow. So.
Right. Now, all the time, every time you see all-time lumber prices are only going to go up, and they just shot down 50%. By the way, Frank, one of the things that we're doing, we've leaned on the value side in our global allocation. So we have this global allocation, which is a much more traditional style of investing, right? We use mutual funds, ETFs. We balance it out depending on the risk of a client. And let's say that we have a moderate risk client, I'm just making this easy, and we decide, you know what, hey, let's look at the world where we are. Let's look at valuations. Let's look at a balance. Let's look at how these things will work together, the correlations, et cetera. And we say, again, circuiting this to get to the point. You know what? Right now, value is a better proposition than growth. The large cap value, we want to put about a 70% versus 30% of growth in the portfolio right now. That has done wonders for our risk this year, right? Very recently, we start to push a little bit back towards growth. So that 70-30 is now going to be about 60-40. And still leaning on value, but bringing it a lot closer, because there is still a 14% differential on a ratio basis, just raw return of growth versus value up and down the range from large cap to small cap. That's a pretty big number. And if in fact we see a Fed that just slows down a little bit, if in fact we see that the world does start getting a little bit more into a recessionary period, if in fact we do see that dollar coming off of those ridiculous levels, all-time low against the yen, I believe, right? 137, isn't it? In parity, which, by the way, do you spell parity with O-D-Y or I-T-Y when it comes to the euro?
I-T-Y, I do.
Just wonder. Yeah, well, I think it's parity anyway, but yeah. I think it's both. So, what you have right there is I agree with you, a recipe for, if nothing else, a reversion to the mean trade, if nothing else, right? Just getting back to a little bit more of a realistic level comparative wise. So I agree with you.
And I'm going to share this with the audience and with you as well, which I think I'm going to start looking at. I start looking at it briefly, but start looking at companies that IPO'd in the past 18 months. And here's why. They're down enormously because they pitched this great idea, like this is the next generation, and even I'm not Virgin Galactic and the whole world's we're going to space, right? We're going to space. Everybody's going to space, right? And then the stock got crushed and everybody got out and Chamath and stuff. We know that. But when you're looking at these companies down 80% plus, they raise, excuse my language, a shitload of money, right? Which they have on their balance sheet now. They were trading at 20, 30, 40 times sales, which is ridiculous. Now they're trading at 5 times sales. They still have their growth model intact, but yet the valuation has come down to the point where the amount of cash that they have to spend, some of them are going to get attractive down 80%. I know it's hard to see that.
And they're cutting expenses. Expenses. I could tell you private companies and all sorts of companies, they're just laying off people left and right. Yes. That is a big, big part of their overall expenditures. They don't need all those people. All these players are like, hey, we have a great app. Why deal with all these individuals and all that? Meanwhile, they just loaded up with employees for no reason. They wanted to manage 1,000 employees. What are you talking about? And why do we have to have people constantly coding all the time? Can't we get to a point that things are set a little bit, with your product and the things that's going to benefit? So I agree with you. I think there is some great opportunities. I mean, people were laughing when I was looking at DocuSign recently, on the bottom, right? Towards the bottom of this. I think still a little bit of an older company, but there's still a very sticky factor that, yes, real estate transactions are going to slow down dramatically over the next several months with interest rates as high as they are. And that would mean that DocuSign, questionable. But you know what? Still, for other areas where you have it, that doesn't mean necessarily you're going to drop it. Smaller companies are going to probably keep it. There's a free version for a few things, of course, just for reading. But I got to tell you something. Once you get into that lobster trap of utilizing a product like a Salesforce or a DocuSign or a Ring Central, there's no getting out of it. You just can't get out of it.
Yeah, it is hard to get out of it, but it's, when I'm looking, not just that area too, is, and one thing I know you could attest to this is when we see markets like this, we just total destruction and everything down across the board. We've seen this playbook. And what happens is you have the survivors, and the survivors are the ones with cash on their balance sheets that could buy a lot of these names. And you're even seeing that in crypto, where crypto, it's so great what's happening because there's so much bullshit in it. But you know what? Look what's happened. Some of these things are up 40, 50% in the past 14 days, like the Avalanches, Ethereum, Solanas. I mean, these are good names that got wrecked along. And I would say 10% of cryptos are real. But even when you're looking at a lot of these companies that came out crazy valuations, the ones who are able to survive are huge. We've seen that with Amazon. We've seen that with Microsoft. We see that with Google. You go through these periods where everything gets wrecked and they're not used to, they don't know what to cut. I mean, there's a reason why not even bank balance sheets, but you're looking at tech companies, their balance sheets are so strong because those companies that lived through that .com and survived. Yeah. I mean, some of them won the
never again,
like weeks, months away, great companies, and they were like never ever again. And they know that it's cyclical. I mean, they say it's secular. It's secular until the economy does what it's doing right now, right? Then you realize a lot of things are cyclical sometimes. Even technology could be a little bit. But it gives you periods that you could really invest. You should be that way with an investor. I mean, if you have stops on your investments, which we do it a lot, and we stopped out and everybody's got to get hit here, but you have money in the sidelines where things are down 40%, some things are down 70% that are good names. It's a good opportunity to start getting in, because when the Fed reverses or the Fed just hints at, hey, you know what, we're seeing everything come down, we're just going to wait. And even if they say we're going to wait and see before we go forward any more rate hikes after September, that's when I think you can really see this market take off. But it all depends on the data, and you got to be willing to change in a second, because we could see inflation really, copper go back up, oil go back up, and gasoline prices go back up. We got to pay attention, right?
So yeah, can I mention something that tags off of what you just talked about? A really good lesson for people that are investing. You could take this for trading as well, those traders out there, but I'm talking about investors. A lot of times we have the idea that, hey, we got a stock and it went against us, and I really liked the stock for a long period of time, and it went against us, and damn, I got stopped out. Man, I'm never going near that again, right? The jonesing on a stock. Mm-hmm. And that's the worst thing you could probably do, because stocks don't care about you. The prices don't care about you. You made a mistake on entry. That's all. You may be totally right about the name itself in terms of their outlook and their future. Never just give up on something. Now, on the second thing, never try to just get back at a stock either. Right? Oh, I'm going to get back on that one. That one ruined my day. I lost all sorts of money. I'm going to get back by doubling up. No, that's not what we do. But what we do is we keep an open mind to where we are putting our money and allocating to the best possible place where we can find opportunity, risk-adjusted opportunity, right? Mm-hmm. And if that stock or that ETF or that investment of any sort still makes that criteria today, and maybe albeit at a lower price, or maybe it's a little bit higher price than you sold it, I don't care. It's not about what happened, it's what's going to happen. That's what we need to look at. Just a quick lesson. And risk adjusted
is very important. People don't realize, like, when you see interest rates at zero and you're flooding the market with trillions in cash, you want to get aggressive, you want to borrow more. That makes a lot of sense. But in markets like this, where people always say cash is the worst investment with inflation, going through the roof, cash is terrible. Tell that to the guy who's been in cash since January and see if he's pissed off compared to you who's been invested in stocks. Sometimes
so let me get this straight. I have cash, 100,000 in cash, and inflation's at, let's say it's the end of the year now, let's fast forward, and I'm down 8% because of inflation, but not really. But yes, okay, mm-hmm. I can buy 8% less. Meanwhile, you have these stocks, you're down 15% on them, but aren't you down 15% plus the 7? Are you down 22? Yeah. What am I missing here? What am I missing?
All right. So now the fun part. The fun part. Yes, absolutely. So I want to get to some of the ideas, sectors, things that you're looking at right now, which you always share ideas. There's only one time since I've been doing these for over 10 years now that you said I'm not recommending anything right now. And that was like 4 months ago. What about now? I know there's things opening up right now.
So the U.S. dollar, I find, is an interesting situation right now. We talk about how high it's gone. Everybody's like concerned about it going over the other side. We're seeing magazine cover pages on, the almighty dollar, and it's going to be a new world with the dollar and all that. And I'm starting to think that maybe we're getting a little bit overextended just a bit with the dollar. There's a few things that are interesting in that area. You look at, for example, oil and oil services continuing to see a real opportunity, as we talked about earlier. It's things like, without getting too specific, because there can be a lot of different investments, right? There's a whole an area of investing, whether it's in the services, whether it's in the actual drilling, whether it's in the distribution. But XLE, for example, holds some of the majors at the top of that range. XLE is a oil services oil and oil services ETF that holds all of them. So that's kind of will follow along to a degree of where oil's going. The other thing is biotech. Now, I think you were talking about biotech a few weeks ago.
Biotech's amazing.
Remember you?
I mean, look, there's a shot.
Biotech's been great.
Oh man, I've never seen an industry so destroyed. Where, if I had to say this, it's got to be a record, because it was a record for the most. I think it was 8 or 9% of companies in a Russell were trading in their cash value, which was a record, and that was a couple of weeks ago. I would say it's got to be a record on companies trading near cash or
well, it's because nobody.
Biotech. Annihilated.
Nobody gets sick anymore. It's only COVID. You only get COVID. It's the only thing you possibly can get and monkeypox. COVID and monkeypox, the only two ththings you can get. Yeah.
I mean, biotech, if you're looking, and I'm not talking about buying a biotech, and you can. I think it's worth it. We're buying, hey, we're placing all emphasis on this one drug. It's at phase 1, and it's got phase 2 results coming out. I'm talking about companies in biotech that are making millions, tens of millions, hundreds of millions of dollars in sales that are down 60, 70, 80% from their highs.
Crazy.
Still generating that revenue, not seeing a massive decline, because healthcare, I mean, inflation through the roof, that you're not seeing, again, when the government pays for a lot of this stuff, you don't see slowdowns. For me, when I look at some of these biotech names, man, it's a no-brainer. And what do we see? Someone that covers that sector a lot is a lot of the big names were leveraged out the ass. I have to say it like that so you're paying attention. Like leveraged, as you have no idea. Guys that have 12, 15, $20 billion funds, and a lot of that has come out to the point where they had to sell, was forced selling. But I like this, out of all the industries to make, from a risk-adjusted standpoint, I mean, you could make a lot of money investing in biotech stocks. And I mean, that has been annihilated.
Yeah, no, I agree. So one of the ones I have that I've been actually put one on a client's portfolios. And again, some of this is mixed into our growth side on the small cap in particular, but some specific names, for example, are involved in the CRISPR area, which is a lesser known area. It's still not proven entirely. I'm hearing some really good things about this area from a variety of places, by the way. They're getting closer and closer.
You've been familiar with this
What's
area
that?
And research. You've been on this area for a very long time, even before like COVID.
Yeah, I'm back and forth. I owned CRISPR for a long time personally, by the way. And then I think I tripled my money or doubled my money on it. Or it was close to triple probably. Then took most of it out, started coming down, a little bit left, kind of came down on me a bit, moved out of it, and then entered back on some ridiculously low levels on that. Recently, there's a couple different companies in this area, probably 3 or 4, but 2 of them I like. It's one's called CRISPR, just CRSP. Is the symbol. The one is Editas. The symbol is EDIT. Recently bought that for client portfolios on a little bit of a pullback, and up. I think we're up 25% in the last couple of weeks on that already. That moves around a lot. But both of these have opportunity, and if there is somehow the potential for them to come up with a solution to deal with some genetic, and particularly when it's in vitro, you deal with some of this stuff. I mean, that's some power of snipping one strand of your DNA, changing this chromosome and replacing it and reprogramming. That's pretty cool stuff. Cool stuff. So
and that technology is further along than most people believe.
Yeah.
I mean, this is something that we talked about 15 years ago, 10 years ago. It's been better and better. But again, when we got COVID and then, just funding issues, and now we see what's going on right now in inflation and money just falling out of the market. But man, I mean, biotech has been absolutely annihilated. So I'm glad you brought that up, because people don't talk about biotech. It's been worse than some of the IPOs and some of the crazy meme stocks down 80% plus. So
I got 2 other biotech long shots, totally going to be dependent on monkeypox, which we can scoff at if you want. I don't care. But you know what? I think if you think of the mindset of governments in the face of what happened and their total failure during COVID, right? To do anything of a reasonable length of time, or even to get the masks right or not right, or the containment or the lockdown. Everything was just botched from start to finish, right? We don't know still to this day if the lockdowns help or not. China's still doing it. I don't understand, by the way, Frank, how China's ever going to open up again, ever, if they continue with this policy.
They have to, though. They have to. They got to fall so far behind.
If they have COVID
big mistake, staying closed. Big mistake. I mean, people are moving their supply chains, which is their bread and butter, and that's what it's coming down to. So they better open up, because statistics show from almost every single country that, come on, enough. We know the people need to be protected with COVID. The vaccines are out there. If you got boosters, you're okay. Most people, again, when we're on airplanes, the people that you hear and have COVID now, they're getting it. It's a cold, maybe something a little bit worse for some people. I'm not discounting it, but you shouldn't be closing down the entire world right now. We know that was the dumbest thing. It'll mark one of the dumbest policy moves we've ever made in U.S. history when they start writing about it. Yep. And that's what led to all the inflation, the money flowing, and that's another story. But China will get it right, because they have to. Unless they want to destroy their economy, they have to. Yeah.
During COVID, by the way, I got, I had a situation. I don't know if you know this, that during the whole thing, I had a slight case. But the worst thing that happened to me during that time was I got gout, because the first thing I did when I heard that everything was being shut down is I ordered about 8 cases of potato chips. Not kidding either, in my office, okay? The second thing we did is we stocked up on all sorts of meat, bought some smokers, and we were smoking meat for days on end, weeks on end, eating it in the office. And one day I'm like, what's going on with that toe of mine? That doesn't feel right. Turns out I had gout from all that terrible eating.
What's your Twitter handle?
My Twitter or my Instagram? Twitter is Andrew Horowitz.
Andrew Horowitz, because I know you post. Forget about listening to Andrew about investments. This is much more entertaining on Twitter, where you post all the stuff you smoke. It's great.
Yeah, that's over on.
What do you send me that stuff?
That's go look at Dad Bod Food Blog on Instagram. Dad Bod Food Blog. You got the Dad Bod, and Food Blog. So my kids made that up for me. So I post I post a lot of stuff that I do and I eat. So the other thing is, there's 2 companies in that area. There's a few different companies, but one is SIGA Therapeutic or SIGA. What's it? Technologies, and they make a monkey. Oh, well, actually, these are smallpox, which are being utilized for monkeypox. There's a company out in Europe that does most of the vaccines, but these are being bought by other places to make sure that in the event of. There's also EBS. Which is another company. So let's just skip on from there. The other thing I want to talk about is I was thinking about what's up with Ford. The biggest problem I see with Ford, and I've always really not loved them, although I do own them. I haven't owned them for very long, but after this latest just blowout of the shares, I said, oh my gosh. Looking at the company, ratios look relatively good. The biggest problem I have with them, of course, their legacy costs. And that's the big leg up that a Tesla has on them, on all these companies, is they don't have any legacy cost, Tesla, right? They have more people on the payroll of Ford that don't work than are on the payroll that do work, right? From all the retirees and all the pension plans.
It's not just
but if you look at that,
they've taken on a lot of debt. And I think, listen, the uncertainty and the transparency where you had a CEO that was lying out his teeth about supply chain issues, and we figured them out a year ago and 18 months ago, which was, again, he's just lying out his teeth. He knew it. He sees the data.
And the EVs. Oh, we have EVs right around the corner, and we're doing this.
Do you notice that what they just came out with is a great, a new version of their F-150, right? I don't know if you saw it, more horsepower, more. It's beautiful, right? But it's gas guzzling, right? Because now they're realizing, like, holy cow, we can't shut off the engine that generates all this money when we can't massively scale.
Sure.
How many cars have Ford produced EVs? I want to say 4,000 or 5,000, I think, and they all got recalled already. Don't discount that. Where Tesla's still, I don't want to say light years, but if you really look at the factory, you could do a YouTube video where you see it, and they have like these drones where you see how their factories run and the machines that build the machines in terms of Tesla compared to everybody else. It's
amazing.
Night and day. And not only that, when you see Ford 4 years ago, we're going to spend $8 billion to build this plant and new technology. Now it's $12 billion. I think it's up to 30, 35, 40 billion, whatever it's up to, because
it doesn't stop.
They have to get the technology in place. With that said, I was saying this a lot in the 20s or 15. Now it's 12. It is off its lows of 11 over the last month, and nice gain here, 10, 15%. But they have to figure it out. They have to figure out how to scale, how to get more EVs out there, because they're coming out when everyone else is going to come out. We've heard the competition, and Tesla's in trouble for how long? For 3 years, and no one's really coming out. In California, you're starting to see a few here and there. not so much every place else, but they have to start getting these vehicles out, and you have to be prepared because the first generation of these EVs, it's not going to be pretty. It wasn't pretty for Tesla. You're going to see recalls.
Yep.
Yeah, it's a whole new different business model.
So here's what I want, Frank.
Yeah.
I want the F850. Okay. What I want this to be is fully electric with maybe a little generator on there. Actually, I'd like a generator that is going to be charging the EV in the event something, go too long. It's probably going to be a very heavy car. It can pull all sorts of stuff. I want it also to be enough power to power my house as a backup generator. I'm not kidding. In the event that we have a storm for an extended period of time that has the generator built in. Or if I go somewhere, I can camp out and have full electricity. Now, why don't we have something like that? Explain to me where we don't have any kind of reverse ability to plug, I don't know, something into a car and utilize it. Does that make any sense to you?
I guess it does. That's where we're going to go.
Things I can plug into.
Yeah, look, what I do know about Ford and what we're going to is when you look at Tesla, like the supercharging stations and things like that are huge. And they say that's a big drawback. That's the number one reason I think they just took surveys of why people will switch to EVs is we don't know how we're going to charge it. And there's a learning curve there.
That sucks.
Everyone assumes that everybody's going to buy this. But you know what? From my... I have experience with this for a long time, being right, being wrong, and different trends and stuff like that, following for over 3 decades. If you make something easier and cheaper, it works. EVs are not really that much cheaper, and it's definitely not easier than going to your gas station. So you're basically forcing people to do something that's going to require more time, and people hate that. You want proof? Do a sales funnel where they have to go through 1 or 2 extra pages, and you lose them, right? That's how quick they lose their attention span. So it's going to be interesting. I've seen some EVs. I test drove some EVs. They're absolutely amazing. I'm hoping Ford gets it right. It'll be pretty cool. They do have a nice lineup of cars coming out, but you
know what the one advantage is, right? Of EVs?
What?
You could smoke while you're filling up your car. And I got to tell you something. All these people that are so like absolute environmentally conscious. Do you know how many people I see smoking while they're filling up their EVs at the supercharger stations? I'm like, is that good for the environment? I don't think so.
I mean, I think it's great. I mean, if you're for climate change, fine. You're for climate change. I was in, Las Vegas at a conference for Metaverse recently, and you see the difference in people over there. But I just think it's funny where, our administration, no coal, no nothing. We got to worry about the environment. No oil, stop producing oil. But yet you'll go someplace else like that oil doesn't affect the environment. Let's see if the science.
Frank, your other guests don't interrupt you and they don't call you out. Am I right? The other guests are patient. They're polite. But you know what? Now you say something that bothers me. What? Can I call you out on this, please?
Go ahead.
Frank goes physically to Vegas to go to a Metaverse conference. Mm-hmm. That is just an oxymoron, dude. How does that work? I don't understand. Isn't the whole point of the Metaverse so you don't have to schlep to Vegas? You just put on some goggles and you're like, hey, what's up, Charlie? What's up, Frank? What's up, Sarah?
Yeah, we're almost there. We're pretty close, but that is funny. But I can tell you the ideas, you know what, really quick, this story, because I remember Matt Damon, who's, liberal, and I like him as an actor. He's a great actor. And he did this movie on oil, not the one, like a recent one.
The one where it blew up?
The one where it blew up? This is a recent movie, so it's not the one where the environmental, whatever. This is a different one. So anyway, he went there and he said he was talking to these people. And he got it. Like, he was just like, these people are passionate about oil. He's like, and I know the liberal, they got on him a little bit, but when I went to Vegas and saw a lot of the projects that people want to do in the Metaverse and how it's going to impact climate change and how much they believe in it, it was remarkable. Like, it was, for
Stillwater?
me, sometimes I think that might have been it.
Yeah.
But then you hear, just the media just pushes it out where you either have to not believe in climate change at all, or you got to the whole world needs to change right now. No oil, fossil fuels immediately. There's such a huge middle there, but just to see the passion behind it and a lot of these projects that they're building within the Metaverse and just, it was pretty cool. It was all giving back and different.
But Frank, look what a great job they did. What a great job they did at changing your vocabulary from what we had, which was global warming, to climate change, which is the standard thing that we say.
Yeah.
And they did it in such a way so that no matter what, they can't be wrong. If we have too much heat, it's climate change. If it gets cold and we have a massive snow, climate change. Winds, climate change. Right?
You got to go back to global warming, though, since it's record heat everywhere.
Oh, yeah, now they will. Oh, the streets are melting and buckling in Italy.
Just crazy.
That's a problem. Listen, I agree something's not right. Well, let's agree that something's not right.
Yes.
Can we agree with that?
Facts. And when you have this is serious, like 15,000 scientists say that there's no climate change, and another 20,000 say there is. There's something wrong there. I mean, I can see there's a few outliers.
Here's the problem. It's just like the Fed. They can't make decisions based on one or two different monthly or even a quarter's worth of data. The fact is, we're talking about billions of years that things have changed and over time. We can't look at the last 20 years and assume anything. You can't make any calculation. I'm not even saying that climate change is wrong. It is very possible. Maybe we are going through some climate change. But by the way, if in fact we are really going through a climate change that is going to heat us up over the next number of years, we're in deep doo-doo, right? Yeah. Because that's a fast move. That's the end of a curve that's going to go parabolic, and basically you're going to be melting your sneakers onto the sidewalk.
Yeah, I know. I mean, I can imagine emails now that this turned to climate change. So anyway, listen, you gave us a lot of names. Yes, FrankCurzioResearch.com. Feel free to send them to me. I'm here. Yell at me if it makes you feel better. Get all that anger out. I'm here for you. I love you guys. So it doesn't matter. So if someone wants to get in touch with you, learn more about you, Andrew, how can they do that?
So go over to thedisciplinedinvestor.com. Listen to me on the Disciplined Investor podcast. You find that on every app, podcast repository, anywhere that you want to find it, from Amazon to Apple and all that. You can get my audio book, which has been around for years, The Disciplined Investor, over on Audible. And every Tuesday, we do a live show with John C. Dvorak, myself, called DH Unplugged, where we deconstruct and go through all the news in a much lighter way, kind of learning a lot more, play some games and do some great giveaways. DH Unplugged.
All right, sounds great. So listen, as always, thanks so much for coming on, man. I love you. Anything you need from me, let me know. But really great podcast. I appreciate sharing ideas. And
I think people should wonder why they're not seeing you, and it's the black eye, right? Someone give you a black eye. Is that why you're not? Where's the video?
Out my teeth. Yeah, black eye and knocked out my teeth.
So I would write Frank and ask him to show a picture of what's going on.
Great stuff. Definitely. Thanks for coming on, buddy.
All right, see you, Frank.
All right, take care. Right, guys, as always, great stuff from Andrew. If you watch it on YouTube, the video, just with the questions, we had a little technical difficulties there, but you saw Andrew's beautiful face the whole entire time, which was cool. So just love having him on because we can go anywhere. And you can't do that with all guests, right? There's guests that specialize, whatever. If it's crypto, if it's small caps, large caps, whatever. Going from the economy to Bitcoin to sometimes politics and how that impacts stocks and investing in your allocation and stuff like that. So Andrew's been a good friend for a long time. You guys know that. You guys say he's one of your favorite guests that I have on. And the best part is he always shares ideas other than 3 months ago, which was actually a good call. First time that I've been interviewing him over 10 years, I think, that he didn't share a pick, which is, again, was very, very good. But he shared a lot of picks for you. And biotech, guys, is really, really an industry you need to look at. We've recommended several biotech stocks recently in our newsletter. I mean, no one's really talking about how terrible this market has gotten hit. We hear about the meme stocks. We hear about Bitcoin and crypto and all these things down 78%. And biotech is right there. One of the hardest hit sectors, doesn't deserve to be. A lot of these companies, even great companies, have gotten nailed that are generating revenue. It's a good place to look for new ideas. And Andrew shared lots of them. So great stuff. Appreciate him coming on. As always, I say this podcast is about you, not about me. So let me know what you thought. FrankCurzioResearch.com. That's Frank at CurzioResearch.com. And that's it for me. Questions and comments, I'm here for you. It's the same email. Really appreciate all support. And have a great weekend, guys. I'll see you next week. Take care.